What's up everyone, it's Connie with MoneyVest. So I've got a super important video for all of us today because there's a very important chart that was circulating on Twitter that I wanted to address, and it's quite an interesting type of analysis, and I think these types of analysis are very important for us to get an overview and a clear understanding of the current economic landscape, and also where a lot of these companies are sitting with respect to their financial statements. So hope you guys enjoy it and find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. And link to our Discord and Patreon is going to be down below if you're interested in joining. Did open up a few more spots with that 16% annual discount that's available. And you get access to all the members-only private videos, all the buy and sell alerts, options alerts, trade ideas, and we've updated our stock reports with 5 new company reports. So this right here is an update that I sent out in our Discord earlier today. So 5 new stock reports added. These are very, very detailed individual stock reports and analysis on companies. So we analyzed Chipotle, we analyzed Lululemon, InMode, Viva Systems, and Endava. These are all fantastic companies. So if you want to get access to all these MoneyVest stock reports, link's going to be down below. So far, we've got 9. And this week, we are analyzing 5 more, including AMD, Netflix, and a few more that I think are going to be super interesting. And as these companies report these earnings, and the earnings season just getting started, we're going to have more and more companies and their stock reports as well. So again, link's going to be down below. We'd love to have you on board. So this right here was the chart, okay? This was posted by Super Macro. So again, shout out to them. And Tom Lee basically retweeted and said, good chart, okay? So this is what they mentioned, right? So prior to great financial crisis, the Federal Reserve's hike, in other words, interest rates going higher, took a larger bite out of corporate profits. But in aggregate, the tightening cycle appears to have had no impact. Many corporations are unleveraged, and those with net cash balances are now earning a healthy rate of interest rates in the money market funds, while larger corporations with access to the capital markets have termed out their debt at low fixed rates across the whole economy, including privately owned corporations. The net dollar amount of interest being paid each year is little changed in nominal terms over 16 years, despite the profits that have soared. Okay, so this right here is the chart that they have on there in that tweet. And what this is showing us is the net interest paid as a percentage of profits right over here. The blue line is the net interest paid as a percentage of profit. And this number has been going down since 2010. So in the last 13, 14 years, it's been coming down, meaning that as profitability has gone up, a lot of these companies are unlevered. They're not holding on to as much debt, and a lot of the cash balances are indeed generating net income interest income for these businesses. So their interest expense, right? Interest paid is basically interest expense, is a very, very small percentage of their overall profits, right? So as profits have gone up, cash balances have gone up, their expenses have gone basically flat, or in other words, as debt levels are really low and they're not as levered, their interest expense is low as a percentage of their profits, which have gone up. Now, the problem with this chart is that it is very much skewing the data, to make it look like this, because what does it tell you? That basically tells you that as interest rates have gone up more recently, that has had no impact on net interest expense as a percentage of their profits, and that has continued to come down. So it make it seems like, oh, that's great. That's incredible, right? I mean, the companies are very, very strong. They are incredibly strong right now, and there's no potential signs of anything breaking. There's no potential signs of the economy doing worse or everything's perfect, right? The only problem, like I said, is that it takes into account the magnificent 7, 8, 10, 12 stocks that are basically skewing the data. So what I wanted to do is I wanted to take a look at individual, and I did a video earlier as well, right? This was from Nomura Holdings and Nomura coverage, the interest coverage ratio. They basically talked about this, and they said that interest coverage ratio to come under continued pressure with restrictive rates and hedges rolling off. So how can there be 2 reports completely contradicting each other, right? This right here is suggesting that interest coverages are really high. Interest as a percentage of profits is really, really low. Companies are non-levered, and this report showing signs of interest coverage coming under a lot of pressure. And they basically mentioned that this higher for longer scenario is going to expose a lot of companies that have leveraged loan issuers that are very exposed. And this is especially the case in soft landing scenario with delayed rate cuts as well. So how is it possible, right? And there's companies filing for bankruptcy, 62 new filings in September that we went over earlier. And, so far we have consistently seen over the last, 6, 7 months, 8 months in 2023, they are on the rise. They're going higher and higher each month, and another 123 bankruptcies in the U.S. corporate bankruptcies, and we're going to see the same levels from back in 2010. Well, the problem is the big tech. The big tech has been a problem. Well, it's been both a problem and a very, very nice opportunity because they have rallied quite a bit. It's been both good and bad from a market perspective because they've done really well, right? And as a result, their weighting of the S&P 500 and NASDAQ's gone up substantially. So that's skewing the data a little bit. So what I wanted to do is I wanted to take a look at what the total number of stocks there are in the U.S. markets, of course, and what percentage of those stocks are currently actually do indeed have a negative net debt, meaning positive net cash balances. Now, this right here is exactly what I mean is because companies with an investment grade credit rating, which is your big tech, have been more insulated from rising borrowing costs because they largely locked in low interest rates during the depths of the pandemic. That's exactly what's mentioned in that tweet. However, corporates with lower credit ratings that were forced to rely on loans with floating interest rates are looking increasingly vulnerable. And that's where the risk comes in. It's not the big tech, right? It's the small, medium cap companies that are actually the bigger problem, right? And a team of Goldman Sachs warned earlier this week that nearly half of all publicly traded companies in the US are unprofitable, leaving them particularly vulnerable to rising interest rates. And that's what this chart it does not basically take into account. And there was a comment in this tweet. So in this tweet, there was a comment in at the bottom that pretty much mentioned that you take out the big tech and then see what the chart looks like. It's going to be materially different. And I don't disagree with that. I think it's a good analysis, right? I think that's really what the problem is, that the big tech is kind of skewing that data because they're the ones that are sitting on a lot of cash and very, very low debt levels and are actually generating a lot of interest income, because they've invested that money and their profits have soared. So as a percentage of their overall profits, that has continued to roll over. Now, if you come over to this screener, right? So right now what this shows us is that there are over 8,000 stocks in the US according to TradingView. So this right here, 8,046 is that number that we're working with. Now, what I did here is basically taking into account net debt, right? So what I did, I put in a filter to understand how many companies actually have negative net debt. And that's a good thing. We want negative net debt because that means the company has more cash than debt, because net debt, the formula is cash minus debt. Debt minus cash. And if the company has negative net debt, that means the company has more cash than debt. Out of over 8,000, guess how many companies actually have a negative net debt? It is going to be just a little bit over 1,900. 1,900 matches. And Apple's not part of this, so 1,929 basically. So even if we do like a plus minus 5% for error, let's just round it up to 1,950. And the reason why Apple's not in there, because a lot of their assets are in long-term investments, right? So long-term investments meaning, securities that are maturing in over 1 year. And this formula for net debt is not accounting for long-term assets, and that's a problem. So even if we do take, 1,950 as a round number, you do the math, 1,950 divided by 8,000, right? 24%. 24% of companies in the US have negative net debt, right? That means 76% of publicly traded companies still have more debt than cash on the balance sheet. So there's no interest income coming in. There's interest expense for those companies. And half of those, 50% of overall companies publicly traded, are also unprofitable, right? So they're loss-making companies, and there are companies that actually have more debt than cash on the balance sheet, which is another problem. And I also wanted to take a look at companies that have quick ratio of above 1. Quick ratio is basically taking into account current assets minus inventory and then dividing it by current liabilities. How many companies do actually have a quick ratio of over 1? And you'd be surprised how many of them are right now on a quick ratio basis, which is under 1 year, have bills and liabilities coming due, and they don't even have the current assets to pay for it. That is 2,679. So let's just do, 2,700 for good measure divided by 8,000, only 33%, meaning a third of companies, publicly traded companies in the US, have a quick ratio of over 1, right? And that means 67%, so 2/3 of the company, don't even have current assets enough to pay down bills and liabilities that are going to come due in less than 1 year. That's a problem. Those things are not talked about in those charts because the data's skewed. This right here is going to be current ratio. So current ratio, current assets over current liabilities. It's a little bit higher, of course, because it doesn't take inventory out. 3275, 3278. So let's just round it up to 3300. And now we are working with 41%. So still 60%. 60% of publicly traded companies still have a current ratio that's under 1. They don't have current assets to pay off the current liabilities that are going to be due in under a year. And those are types of sort of scenarios that I want you guys to understand is that, okay, yes, those charts can make it seem like net interest paid as a percentage of profits has continued to come down, which means, yes, companies are better financially positioned, but that's only true for a small subset of stocks, not for the entire market. The entire market is very, very big. As we went over 8,000 stocks, and a very small percentage of those stocks are actually looking at negative net debt with a positive current ratio, with a positive quick ratio. And, that's a problem, right? That's something that we have to discuss and kind of understand how that's going to play out. Now, Mark Zandi also mentioned, as a professional economist, I do lots of forecasting. Some forecasts I'm confident in, some not so much. I'm confident that the growth in consumer prices for shelter is headed much lower, and at this rate, it will push overall inflation back near the Fed's target by this time next year. So this is kind of like a shelter forecast is from Mark Zindi's economist, that they're kind of projecting that CPI is going to be lower by this time next year on the back of shelter prices coming down. We'll find out if that actually ends up happening, but of course, interest rates are still going to be a little bit more elevated and higher for longer. Now, this right here from Liz Ann, unlike bear markets that ended in 2002, 2009, low October 2022 hasn't been followed by a durable outperformance of S&P 500 equal weighted relative to cap weighted inversion. Now, this chart is also quite interesting because if you come over to RSP divided by SPY, that's exactly what she's doing in that chart. This is literally the one that I have right now on my screen is exactly what this is. And what this shows us is that the equal weighted index, which is the S&P 500 equal weighted, every single stock, all 500 companies are equally weighted, has not seen any outperformance after the low from October 2000. Actually, yeah, so it hasn't seen any type of outperformance since October 2022, right? So it's actually lower than the December 21 low. And what this means is, like in the past, after every sort of bear market, equal weighted index actually outperformed. So this right here, since it's going higher, equal weighted outperformed market cap weighted. This right here in 07-08, equal weighted outperformed market cap weighted for 3 years, since 2008 all the way to 2011. But this right here, we haven't seen that. Why? Because once again, it's by S&P 500, which is market cap weighted, and it's all the big tech doing all the legwork for the market right now as well. While small caps and other companies, right? Other companies that are equally weighted, other industries and other sectors are not seeing as much gains as big tech has seen in 2023. That's pretty obvious with what we have witnessed in this year. So that's where we are. Again, we gotta take it with a grain of salt. A lot of the charts that we do see, because it's kind of skewing the data a little bit, and at the same time, there are signs that interest rates are hurting a lot of these companies, because you can see bankruptcies are, picking up, and 62 new bankruptcies in September, over 500 already this year, which again is kind of comparable to that of 2020, but nothing comparable to before that since 2010. So let me know your thoughts down in the comment section below. Don't forget, we do have the MoneyVest stock reports that you can access, and join our Discord and Patreon as well. Link's going to be down below. As always, if you enjoyed this video, find it helpful, make sure that you drop a like. Let me know your thoughts down in the comment section below. As always, happy investing. I'll see you all in the next video.